Now let's say you have a motor vehicle as a business. Remember, motor vehicles are fixed assets. Now there's always a time of purchase, that is more or less saying that the vehicle is new. But at the time you begin to use this vehicle over time, the value of the vehicle begins to reduce or to fall or to go down. And what I'm trying to say is that over time, the cost of the vehicle purchased reduces gradually. Now, as business organizations, our fixed assets are always expected to reduce in value as we use them. This is what we call depreciation. And in this class, we'll be looking at depreciation of fixed assets. As I said earlier, depreciation is simply the fall in the value of a fixed asset. I give an example of motor vehicle. So in this instance, motor vehicle costing 2.5 million in 2010, will most likely not be the same cost in 2019. This is because as you use the vehicle, the cost of the vehicle reduces. So the fall in this value or the reduced value or the value reduction is what we call depreciation. Now let's look at the causes of depreciation. That is, what are the factors that can contribute to the fall in the value of a fixed asset. The first item there is usage. What I'm trying to say here is that the more you use an item or an asset, the cost or the value of the asset reduces from time to time. So as you use an asset, the cost reduces. So usage can be a reason or a factor that causes depreciation. The next one is change in taste, fashion, or trend. The idea here is that the moment there's a switch from a particular brand to a newer brand, it is very possible that the value of the first brand reduces. Let's say there's a brand A and then there's a brand B. Brand A was the first in vogue. The moment there's a switch from brand A to brand B, the value of brand A will reduce. So that reduction can also be referred to as what? Depreciation. So change in taste, fashion, or trend can also cause the value of an asset to reduce. The next one here is change in technology. Now, don't confuse change in fashion with change in technology. Change in fashion, we're saying the taste has changed, the trend has changed. Okay, you have two similar products, but the choice of the users is moving from one to the other. That's change, in taste. But you're talking about change in technology. Say you have you have a vehicle, model A, for instance, the moment the technology or the company introduces or the manufacturer introduces a new model, it is possible or most likely, or there's a high tendency that the value of the first model will reduce due to the change in the technology producing it, because the newer model would probably have recent technological changes, in terms of what the service delivers compared to the first model. So when I say change in technology, there's always the possibility of the value of assets to reduce. Here, this factor here talked about government policy or influence. Sometimes the government of a particular country will send circulars restricting the usage of certain item or certain product. Once the government does that, the demand for that product reduces, and that can also affect, the cost or the value rather of that item. For instance, in Lagos here, the government from time to time expand roads, and this usually cut into people's residential apartments. Now, it is very possible that the value of a property in those areas before the government gave the order to expand the roads, it's possible that the value will be higher before the government gave the instruction to expand the road. But the moment that road is marked, for expansion, there's high tendency that the value of properties there will reduce because of the possibility of losing a portion of that property to the road expansion that the government is proposing. So sometimes the government policy can affect the value of an asset, and that can cause the asset to depreciate. Now we are going to be looking at the methods of depreciation. So what I'm saying is, now that we have established that depreciation is the fall in the value of an asset, so we're going to be looking at the methods of computing or calculating the depreciation. So the idea is, you have a vehicle or you have an asset, you're going to use it over a period of time. Now, if it's going to be for 4 years, 5 years, 6 years, 10 years, depending on the type of asset, we must determine how much we are going to be using, or how much we're going to be calculating as a fall in the value of that asset over time. If an asset is worth 1 million and we're going to use it for 5 years, how much are we going to write off as depreciation? How much are we going to consider, as a reduction in the value of the asset, every year over the number of years we want to use them? So one of the method is what we call the straight line method. Now, the straight line method is also called the equal installment method. What I mean is that over the years of usage, you're going to be charging the same amount every year. So if you're using the vehicle for 5 years, so you're going to be charging the same amount for every year for the whole 5 years until you finish taking off the value of the asset. So this method is calculated as costs minus scrap value over estimated useful life. Now we have established that the depreciation under the straight line method is calculated as cost minus scrap value over estimated useful life. Now, what is the cost? Now, the cost of an item, at the first point of buying, or we call the initial cost, is the total cost incurred in bringing the asset to the final point of destination of usage, and the cost of putting it to first use. What I'm saying is, if you're buying an asset, the first or initial cost of the asset has to do with the cost of buying the asset and whatever cost you incurred in putting the asset to first use. If you're importing the asset, the import duties that was paid, the cost of the asset, and any other charge that has been paid to bring it down, to the importing country, and then any cost you incur to take it to where you're going to use it. That's what we call the initial cost of the asset. So all that put together form the cost of the asset, not just the purchase cost. So your initial cost had to do with the purchase cost and any other cost you incurred to bring the product to the point of what? Usage. That's what we call the initial cost. The next one is your scrap value. Your scrap value can also be called the residual value. So it is the estimated cost of the asset at the end of the what? Useful life. So if we're using an asset for 5 years, at the end of the 5th year, how much are we estimating that the asset will be worth? That's what we call the scrap value or residual value or remaining value. So the value of the asset at the end of the estimated useful life is what we call the scrap value. Now, what is estimated useful life? That is the approved or the assumed number of years that the asset is expected to be used. So if you're expecting to use the asset you just purchased for 10 years, 10 years is the estimated useful life. If it is for 5 years, that is the estimated useful life. If it is for 4 years, that is the estimated useful life. So it depends on what the business has decided, that we should use, as the estimated useful life. Some organizations take advantage of what they call qualifying capital expenditures. That's what the tax authorities approve for usage in computing capital allowance. But that is not for this class, okay? But just understand that whatever number of years that you have agreed or are approved for you to use the vehicle or for you to use the asset is what we call the estimated useful life. Now here are some advantages and disadvantages of the straight line method. We have established that the straight line method is also called the equal installment method. That is, you are using the same value over the number of years. So an advantage here is what we call the less stressful for what accountants to compute. As an accountant, you just pick the cost, pick the scrap value, pick the estimated useful life. Take out the scrap value from the cost and then divide by this estimated useful life to get what cost of depreciation per annum or every year. So it's easy. And then because it is easy, you can also carry non-accountants along. So non-accountants, can easily comprehend this method of depreciating the asset. But a disadvantage of it is that it captures equal value of depreciation for all the years of usage, which does not mean equal usage for the years. It is possible that in the early years you use the vehicle more than the later years. And it's possible that in the later years you use the vehicle more than the early years. So if you're charging the same amount as depreciation, in reality it does not mean that you're using the vehicle equally over the number of years. That is, you can't tell me that the number of times you use the vehicle in 2001 or in the first year is the same number of times you use the vehicle in the second year, but you're charging the same amount of depreciation for the year. So that is a disadvantage of it, that you're charging equal value for the year does not mean that you're using it equally. And that disadvantage, that it is not suitable for all type of it's selective. Okay, there are some assets that you cannot use straight line method for, okay, because of their nature. You don't use straight line method for them. But it's okay, despite the fact that it's not suitable for all assets, it is at least one of the approved methods by tax authority. So that is also an advantage of the straight line method. Now, this is just a quick one. This is what we call part depreciation or depreciation in parts. What I'm trying to say is you can have an asset broken down into various components and then depreciated differently. For instance, a vehicle, you can break it down into its component. That is the engine, the body, the tire, the interiors, okay? And then you now estimate the cost or the carrying amount of these various components and then depreciate them differently. Okay, that we call depreciation in parts, or part what? Depreciation. This approach, is basically, used in recent times, basically to accommodate the fact that some part of an asset outlive other parts. So this helps us to accurately capture assets in their components and depreciate them accordingly. So that is just for you to know. But if you are really interested in doing some other reading, you can pick up IAS 16. IAS 16 is property, plants and equipment. IAS, like I said, means International Accounting Standard. You can just go through it, and then that can give you further understanding on part depreciation. Okay, but basically it is for property, plants and equipment. So let's move on to illustration using the straight line method. Now this is an illustration that will help us compute depreciation using straight line method. So let's look at this question. A vehicle purchased in January 2015 has an initial cost of 1.5 million with an estimated useful life of 4 years. Assuming the scrap value at the end of the useful life is 100,000, using the straight line method, show the necessary account to record the depreciation throughout the estimated useful life. We already know that straight line method is also called what? Equal installment. That means you're charging similar amount all through the years of usage. We have established the initial cost set to be 1.5 million. We have established the useful life to be 4 years, and we have established the scrap value to be what? 100,000. So what's the formula? Annual depreciation is equals to what? Cost minus scrap value over estimated useful life. So what's the cost? 1.5 million. What's the scrap value? 100,000. What's the estimated useful life? 4. So 1.5 minus 100,000 is what? 1.4. So 1.4 divided by 4 gives us 350,000 naira. So it means that every year we are charging 350,000 naira as depreciation on the motor vehicle. So having established the annual depreciation to be 350,000, okay, let's show the necessary accounts. What's it affecting? It is affecting the motor vehicle account, that's the asset account. So that means that we're going to have to look at the profit and loss account, which is the expense part of it. We're going to look at the balance sheet that will show the what? The cost of the asset after taking out the depreciation for the year. So let's go. This is the motor vehicle account. Okay. So in 2015, we bought the what? The vehicle for 1.5 million. Remember, your assets, when they increase, you debit. Okay. So you're using cash to buy motor vehicle. They are both assets. Your cash is reducing, your asset motor vehicle is increasing. So debit motor vehicle, credit cash. So here we're concentrating on our motor vehicle here. So we have motor vehicle here now. Look at cash, 1.5 million, 2015. Okay. So by the end of 2015, it's still 1.5. So by 2016, balance brought forward is 1.5 million. Okay. So by the end of 2016, it's still 1.5 million. 2017 is still 1.5 million. Then by 2018, which is the 4th year, remember we were writing off 350,000 every year for 4 years. So by the end of the 4th year, depreciation would have accumulated up to what? 1.4 million. That's what you're having here. This is the cost brought forward, 1.5. Then we have accumulated depreciation 1.4. Okay. So So the difference between accumulated depreciation and the what? Cost is what we call the scrap value, which is 100,000 naira in the question. So basically, the depreciation for the 4 years is 1.4. The cost of the vehicle, 1.5. The difference is the scrap value. Okay? So this is how the motor vehicle. So basically, your motor vehicle account is constant all through the year because you have an account, taking the word depreciation into consideration. Taking depreciation into what? Consideration. So it means that, there's what we call accumulated depreciation. For something to accumulate, it means that what? It is piling up. So the first year, your vehicle account remains 1.5. The 350 depreciation goes to accumulated depreciation. The second year, your motor vehicle remains at 1.5 cost. Your 350 for the second year goes to the accumulated depreciation, making it 700,000. So it goes on and on and on until the last year that it now comes to the motor vehicle account for us to close the account. So basically, this is how the motor vehicle account is. The next one is your depreciation account. This is your depreciation account. Remember, depreciation is an expense. Okay? Remember your trial balance. So this is not a big deal. So we have 2015. Okay, this is accumulated depreciation, 350,000. This 350,000 goes to where? It goes to profit and loss account. That's why you're seeing it here. So I agree with balance. I have 350 here. Profit and loss account. Okay, so that means that in 2015, your profit and loss account, see, depreciation is 350,000. Okay. And then you have your what? Accumulated depreciation. Look at it here. 2015. You see depreciation here, 350,000. Balance carried down is what? 350,000. So this becomes balance brought forward in the following year. You see? So you now have depreciation again for 2016, 350,000, making it up to 700,000. Okay? So in 2016, depreciation again is 350,000 for profit and loss. 2017, this balance carried down becomes balance brought forward, 700,000. You now charge another 350,000 for 2017. That's 350,000. So that takes what? Accumulated to 105. But this 3,000 is what you're charging for 2017. That's what you have in profit and loss here. Depreciation, 350,000. In 2018, this 105 becomes balance brought forward, accumulated depreciation 105. You're charging depreciation for the year, 350,000. That's what you have in 2018, 350,000. Okay, so basically at the end of 2018, your accumulated depreciation has what? Piled up to what? 1.4 million. That is what you're not taking to what? The motor vehicle account. Okay, so in your balance sheet, remember, your balance sheet will capture the net value of the asset, which is the cost of the asset minus depreciation for each year. So in 2015, what was the cost of the asset? 1.5 million. How much did we charge? 350,000. So 1.5 million minus 350,000 is what gives us 1,150,000. In 2016, how much did we charge? We charged 350,000 again. So what will now be the cost of the vehicle? It will now be 1,150,000 minus 350,000. That will give us 800,000 for 2016. 2017, the motor vehicle also reduced again by 350,000. We have 800,000 minus 350,000. That gives us 450,000 for 2017. 2018, which is the last year of the useful life, we have 100,000, which is the scrap value, and that is 450,000 minus 350,000. So what I'm saying is that every year your assets is reported less depreciation for that year. So if the cost of the asset in a particular year is 1 million and depreciation computed is 200,000, it means that the assets you report in that year will be 800,000. The 200,000 that you removed will go to your profit and loss as depreciation. Basically, what we have done here is to calculate depreciation on fixed assets using straight line method. And here we were able to establish that you use the same amount over the number of years that the vehicle is used for. And how do you report it? The value that you compute as depreciation is charged to the profit and loss account as an expense. And then the asset itself is reported net of the depreciation in the balance sheet. Remember, the asset, the non-current asset or the fixed asset is an asset in the balance sheet. But you're going to report it after deducting your depreciation that you charged to your profit and loss account. This is the straight line method. The next class, we're looking at another method, which is the reducing balance method. If you have questions on straight line method, you can reach me on 08136506356 or send me an email, jeremiah.dosu@gmail.com. Drop questions in the comment section. I'll be there to reply with the right